Ripple and XRP just made one huge step towards the financial big leagues, or better known as Wall Street. Apart from that, Clarity Act passage talks are in peak, and Ripple CEO Brad Garlinghouse puts the odds of passage very high. These are 2 out of 3 updates we will discuss and explain today. Third one will be a huge surprise, and you will understand why once you reach that part of the video. Alright, let's see what's been cooking between Ripple and Wall Street. Ripple Prime has now appeared inside one of the most important pieces of Wall Street's post-trade infrastructure. And for XRP investors, this is exactly the kind of story that needs to be explained carefully. The confirmed development is that Hidden Road Partners, CIVUS LLC, now connected to Ripple through its Hidden Road acquisition, was listed in an NSCC directory notice with a first trade date of March 2nd, 2026. NSCC stands for National Securities Clearing Corporation. It is part of DTCC, the Depository Trust and Clearing Corporation, which sits deep inside the plumbing of traditional US financial markets. In simple terms, DTCC and NSCC help handle what happens after trades are made. When institutions buy and sell securities, the market does not only need a buyer and seller, it also needs systems that confirm the trade, clear the obligation, manage risk between parties, and help settlement happen correctly. That is the post-trade layer. It is not the flashy part of finance, but it is one of the most important parts. Ripple did not just acquire a crypto exchange or another wallet company. Ripple acquired Hidden Road, a global multi-asset prime brokerage firm, and then rebranded it as Ripple Prime. A prime broker is a financial service provider used by professional trading firms, hedge funds, and institutions. It can offer access to markets, liquidity, financing, custody relationships, and clearing arrangements across different asset classes. That is important simply because institutional finance does not move the same way retail crypto does. Large financial firms usually do not adopt new infrastructure because a token has a strong community or because social media is excited about it. They need reliable systems, compliance, access to liquidity, auditability, and connections to the financial infrastructure they already use. Ripple Prime gives Ripple a more direct position inside that institutional environment. The NSCC directory listing does not prove that DTCC is using the XRP ledger. It does not prove that NSCC trades are settling on XRPL. It does not prove that Wall Street settlement volume is suddenly moving through XRP. The official listing confirms an operational market infrastructure entry for Hidden Road, now Ripple Prime, but it does not say that the XRP ledger is being used in those specific clearing or settlement flows, at least not yet. A lot of crypto media tends to collapse several ideas into one sentence. Ripple owns Hidden Road. Hidden Road has an NSCC listing. Ripple is connected to XRPL. Therefore, the conclusion becomes that DTCC is connected to XRP. But that final step has not been proven by the directory notice itself. The more accurate version is a bit broader. Ripple now owns an institutional prime brokerage business that has a connection to traditional post-trade market infrastructure. That does not automatically mean blockchain settlement is happening today, but it does place Ripple closer to the financial plumbing where future blockchain-based settlement tools could become relevant. Ripple's broader strategy has been moving beyond a simple crypto payments narrative. The company has worked on payments, custody, stablecoin infrastructure, institutional liquidity, and now prime brokerage. Hidden Road, now Ripple Prime, adds another layer to that strategy because it deals with professional market participants across both digital assets and traditional financial instruments. Adoption does not usually happen as one dramatic switch. Banks and institutions do not simply abandon existing market infrastructure overnight and replace it with a blockchain. In most cases, adoption starts by connecting new systems to old systems. The first step is not replacement. The first step is compatibility. Ripple Prime being listed in an NSCC-related directory suggests that Ripple's institutional business is operating closer to traditional capital market workflows. It gives Ripple a stronger position to serve clients who may want exposure to digital assets while still relying on familiar clearing, settlement, and brokerage structures. That is different from saying that XRP is already being used as the settlement asset for those transactions. And for XRP, the connection is more indirect at this stage. XRP is the native asset of the XRP ledger. On XRPL, XRP is used to pay transaction fees. The ledger is designed for fast settlement, usually within a few seconds, and it has long been positioned as infrastructure for moving value efficiently. If more institutional activity eventually moves on to XRPL, then XRP could become more relevant as the asset that supports transaction processing on that network. But that depends on actual on-chain usage. A directory listing by itself does not create meaningful token demand. It does not automatically increase settlement volume on the XRP ledger. It does not prove that institutions are using XRP as a bridge asset, holding XRP for liquidity, or routing capital market transactions through XRPL. As for XRP's price reflection, this means the development should be treated as potentially constructive, but not immediately decisive. Markets often react to infrastructure news because investors try to price in what could happen in the future. If Ripple Prime becomes a major institutional gateway, and if parts of its post-trade workflows eventually use XRPL, then the market could view that as a stronger long-term adoption signal. But the important words are if and eventually. The current evidence does not yet show measurable XRP demand from this NSCC listing. This is why the price has not necessarily reflected the long-term narrative. Investors may understand that the infrastructure story is improving, but markets usually need more than strategic positioning. They need visible usage, transaction volume, liquidity movement, institutional flows, or clear confirmation that blockchain settlement is actually being used. Until that happens, this remains a structural development rather than proof of direct XRP demand. Still, it should not be dismissed. Institutional adoption often begins quietly through boring operational steps. Directory listings, clearing relationships, custody integrations, compliance systems, and brokerage access are not exciting in the same way as price predictions. But these are the details institutions usually care about before serious usage can happen. The strongest interpretation is that Ripple is moving deeper into the infrastructure layer of finance. Ripple Prime gives it access to institutional clients in traditional market workflows. NSCC connectivity gives the business a bridge into established post-trade systems. XRPL gives Ripple a blockchain settlement network that could become more useful if real institutional activity starts moving on-chain. For XRP, the long-term relevance depends on whether this infrastructure eventually produces real XRPL activity, real settlement flows, and real liquidity demand. All right, it is finally time to move on and explain the most talked about headline, and that is Clarity Act nears a crucial deadline, and Ripple CEO Brad Garlinghouse has put the odds of passage at a high percentage. Clarity Act is not just another crypto bill sitting in Washington. It is one of the most important pieces of proposed market structure legislation for digital assets in the United States. If it moves forward, it could help define which digital assets are treated more like securities, which are treated more like commodities, and which regulators have primary authority over different parts of the crypto market. For XRP, that issue is especially important. XRP has spent years at the center of one of the biggest regulatory debates in crypto. The question was never only whether the XRP ledger could process transactions quickly or whether Ripple could build products around it. It was whether institutions could operate around XRP with enough legal clarity to satisfy compliance teams, risk committees, auditors, and regulators. Central idea is that some crypto assets may be regulated as digital commodities rather than securities, depending on how they are structured and used. A security is usually connected to investment contracts, fundraising, and SEC oversight. A commodity is treated more like a tradable asset, with the CFTC playing a larger role in market supervision. Clear distinction matters because the rules around securities are much heavier, especially for exchanges, custodians, brokers, and institutions. If an asset is clearly treated under a commodity-style framework, it may become easier for regulated firms to support it without worrying that they are stepping into unresolved securities law risk. For XRP, this could reduce one of the biggest historical obstacles around institutional adoption. Ripple already fought the SEC for years, and that case gave XRP more legal clarity than many other major digital assets. But financial institutions usually prefer clarity that comes from legislation and formal regulation, not only court rulings. Banks and asset managers do not build major workflows around uncertainty. They need rules that can survive internal review. This is where Garlinghouse's comments become relevant. By putting high odds on passage, he is signaling that Ripple views the legislation as a realistic, near-term catalyst, not only a long-term policy goal. But even with that optimism, the final result still depends on Congress. The bill has to pass through the remaining legislative process, and any final version would still need to be interpreted and implemented by regulators. If the Clarity Act passes, it could make the US environment more workable for digital asset companies, exchanges, custodians, payment firms, and institutional investors. That would be positive for assets that fit inside the new framework. It could also support more regulated investment products, including exchange-traded products and structured vehicles, if issuers and regulators are comfortable with the asset's classification. But regulatory clarity does not automatically mean banks begin using XRP at scale. Banks still need more than a legal green light. They need predictable liquidity, reliable custody, treasury controls, audit trails, counterparty protections, and internal approval from risk departments. They also need to know that the asset can handle real transaction needs without creating unacceptable volatility exposure. That is why XRP adoption is not only a regulatory question, it is also a liquidity and operations question. Ripple appears to understand that. The company has been building a wider institutional stack around payments, custody, stablecoins, tokenization, treasury services, and liquidity access. RLUSD, Ripple's dollar-backed stablecoin, is part of that strategy. Ripple Prime, Ripple Custody, and Ripple's enterprise payment products all fit into a broader attempt to make blockchain infrastructure usable inside regulated finance. This is really important because banks rarely adopt new financial infrastructure in one sudden move. They usually adopt it in layers. First, they need custody. Then they need compliance. Then they need liquidity. Then they need settlement processes that fit with existing systems. Only after those pieces are in place, a digital asset can become part of a serious institutional workflow. The Clarity Act could help remove a major legal barrier. Ripple's infrastructure could help solve part of the operational barrier. The XRP ledger could provide a fast settlement network. XRP itself could become more relevant if institutions use it for transaction activity, liquidity movement, or bridge settlement between currencies. But each of those steps requires actual usage, not just favorable headlines. A clear regulatory framework could also improve market sentiment around XRP, because investors often reprice assets when legal risk disappears. It could also improve the chances of more institutional products tied to XRP, depending on the final rules. But a law by itself does not create permanent price demand. Long-term price impact would depend on capital flows, liquidity, product adoption, and measurable network usage. Clarity timing is important, but it should not be treated as a guaranteed turning point. If the Clarity Act advances, XRP could benefit from a stronger regulatory foundation in the United States. If it stalls, the market may have to wait longer for the kind of federal clarity institutions usually require. Either way, this is not only about one bill. It is about whether the US crypto market is finally moving from enforcement-driven uncertainty toward defined rules. And speaking about US and clearer crypto rules, we have one more positive thing to discuss today. Arizona has taken a notable step in digital asset policy, and XRP is written directly into the language of the bill. Arizona Senate Bill 1649 proposes a state-level digital assets strategic reserve fund, and XRP is explicitly named among the assets that can qualify under that framework. The bill has moved through parts of the Arizona legislative process, but it has not become law. It still needs final approval before it can create an active reserve framework. So this is not completed adoption. It is a formal policy step. The bill was introduced during Arizona's 57th legislature, second regular session, and it gives authority to the state treasurer to administer a digital assets strategic reserve fund. The idea is to create a managed framework for digital assets that are held by the state, confiscated by the state, or surrendered to the state. That is important because it does not appear to be written as a simple instruction for Arizona to go into the open market and buy XRP. The bill is more focused on how the state should hold and manage digital assets that come under its control. That could include assets seized through legal processes, assets surrendered to the state, or other digital assets the state may lawfully hold. XRP is listed directly in the bill's definition of digital assets, alongside Bitcoin, stablecoins, Digibyte, Dash, Monero, Nano, and several other assets. This does not mean XRP is being treated as the only important asset in the proposal. It is one name in a broader list, but it does mean XRP is not being ignored or excluded from the policy framework. It is important to note that because legal and regulatory recognition often happens slowly, it rarely begins with full-scale adoption. More often, it begins with definitions, classifications, custody rules, reporting standards, and risk controls. In this case, Arizona is not only discussing digital assets in general terms. The bill text names specific assets and then builds rules around how a state reserve could handle them. The custody requirements are one of the most important parts of the proposal. The bill refers to qualified custodians, secure custody solutions, private key protection, encrypted storage, access controls, independent audits, and disaster recovery procedures. In crypto, custody is critical because whoever controls the private keys controls access to the asset. And custody simply means how digital assets are stored and protected. That is why these details matter. A serious reserve framework cannot just say that the state may hold digital assets. It also has to explain how those assets are protected, who can access them, how security is verified, and what happens if systems fail. The bill also allows the state treasurer to loan digital assets from the fund in order to generate additional returns, but only if doing so does not increase financial risk to the state. That is a meaningful detail because it suggests the reserve would not necessarily be passive. It could be managed under defined risk limits. For XRP, the adoption impact is limited, but still relevant. This bill does not prove that Arizona will use the XRP ledger for payments. It does not prove the state will buy XRP. But it does place XRP inside proposed state-level financial policy, and that kind of recognition can matter over time. Broader implication is that governments are starting to think about digital assets less like a fringe market and more like assets that require formal treasury, custody, and audit rules. That is a structural shift. It does not create instant demand, but it can help normalize the idea that digital assets need regulated management frameworks. XRP being named in proposed legislation may support sentiment because investors often view government recognition as a positive signal. But sentiment is not the same as demand. Price would be more directly affected if the bill becomes law. If Arizona actually holds XRP, if other states copy similar models, or if this leads to measurable usage and liquidity demand. But in any case, for an asset that has spent years fighting for clear legal and institutional treatment, that kind of recognition is worth watching. And with that sentence, we can conclude today's video. If you truly wish to educate yourself regarding XRP, Ripple, and other cryptocurrencies as well, make sure to subscribe to the channel and turn those notifications on. Also make sure to watch one of the 2 videos that you see on your screen right now. Hope you learned something today. If yes, don't forget to like and leave a comment down below. I wish you all the best and see you in some of my next videos.